So what we just talked about was under applied overhead. So let's talk about over applied. So looking at our T account, let's say that actual is 100, but we're going to change how much we allocated. Let's say that we allocated 120,000. So based on our estimates, we allocated that much. Well, now our balance is $20,000 credit. Well, think about it. I allocated more. I allocated over the amount that we actually had. So when I allocate over the amount we actually had, then I over allocated it. If I allocate under the amount we actually had, then it's under allocated. So work that out in your mind, and you can also use this. Okay, if we apply less than we actually have, we under applied. If we applied more than we actually had, then we over applied. So over applied factory overhead will have a credit balance. Under applied factory overhead will have a debit balance. What we want to happen is it to be zero. So here it's just showing you that if it has the debit, when it has a debit balance, we under. When it has a credit balance, we over allocated it or over applied it. Okay, so here is an example exercise where you apply factory overhead. First, you have to determine the rate, determine the amount of overhead applied to the jobs, and then journalize the entry to apply factory overhead to both of the jobs. When you apply overhead, that means you're putting it into the job, which is WIP. Okay, so during the year, the balance in the factory overhead just gets carried forward and either reports as a debit or a credit on those monthly or interim balance sheets, because remember, factory overhead is an asset, so it will be on the balance sheet. But any balance in the factory overhead account should not be carried over to the next year. Okay, and the reason is factory overhead balances apply only to operations of the current year. So the balance of the factory overhead, when we close it, we're going to get rid of the balance. So if it's a debit balance, to get rid of it, we're going to credit it. Okay, and if it has a debit balance, if it has a credit balance, we're going to debit it to get rid of it. So how does this work? Well, if we have under applied overhead, meaning that there's still some overhead sitting on the debit side, because that's actual overhead, then we're going to close that actual overhead into cost of goods sold, because we didn't apply all of it, so we still have some that needs to go along with our cost. If the ending balance is a credit balance, that means we've applied too much. So if we've applied too much, then that means it ends up going into too much goes into cost of goods sold. So either way, to close the account, just do the opposite. So if it has a debit balance, you're going to credit factory overhead. If factory overhead has a credit balance, you're going to debit it to zero it out. Either way, you close it to cost of goods sold. So that is how you're going to get rid of the overhead balance. So when you do this, you get your balance down to zero. And if it was under allocated, then we're going to add it to cost of goods sold. If it's over allocated, then this is going to reduce cost of goods sold. Now, the reason if it's under allocated, we can't transfer it to a job because we don't know what job it would go to. All right. So let's say you took out $84,000, and let's say you were left with $1,000. If you have under applied, this is how you would do it. But let's say you applied too much and you end up with a credit balance. This is how you would do it down here. So here is the actual journal entry that we're going to do for the under applied. Under applied means we still have a debit, some left in the actual cost that we didn't apply. So that's a debit balance, so we need to credit it, and then we will debit cost of goods sold. Okay, let's talk about work in process. So work in process, all three of these are categories of assets. So when we when we move direct materials into a job, we're going to debit work in process. When we record direct labor, we're going to debit work in process. And when we apply factory overhead cost, we're going to debit work in process. So here are some job cost sheets for the guitars. Okay, you see job 71. Here's the direct materials, the direct labor, and the factory overhead, the total job cost. So when we start on the job, we're going to debit direct materials, direct labor, and factory overhead. And then we're going to, when it's complete, we're going to credit the cost and take that total cost and debit WIP. Okay, so we're going to do that for each job. All right, so you'll see that the 10,250 credit when it's when the job 71 is complete, we're going to credit WIP and put it into finished goods. Okay. All right, so let's talk about WIP some more. During December, job 71 was completed. This is what I was explaining. So the amount that we're going to credit WIP, that WIP includes direct materials, direct labor, and the factory overhead that was applied. Okay, so that total amount of that job divided by the number of guitars we made is the cost per guitar. That's how you determine how much each guitar costs. Okay, so when I'm going to take it out of WIP. To take it out of WIP, it was original debit, so you're going to credit it by the amount and put it into finished goods. So it's just going out of one inventory account and into another. Now it says job 72 was started in December, but it's not complete yet. So this job is going to stay in WIP. All right, so let's look at it. The balance in WIP is the 21,000. It's what's still there. Okay, it's not complete yet. So that is going to be your ending balance for the year in WIP. What's still there and has not been any job that hasn't been finished. Okay, so here is an example exercise. You have to determine the balance on the job cost sheets for job 101 and 102 at the end of March, and then the cost per unit for job 101 and 102 at the end of March. So complete this exercise, check your work, and we're going to continue. I wanted to go back to the slide for just a second because I wanted to make sure that I covered this well enough. So when you move it out of WIP and into finished goods, you do that when the job is complete. So how do you move something out of an asset? You want to move it out of WIP, which is an asset, so you're going to credit it. So you're going to credit WIP and we're going to debit finished goods. So we increased our finished goods and we decreased our WIP because those have been completed. So this is the journal entry that you record when the job is completed and it's no longer in work in process. We need to put it in finished goods. So the finished goods account is a controlling account for the subsidiary finished good ledger. Each account in the finished good ledger is going to contain cost data for the units manufactured, the units sold, and the units on hand. So here is what this would look like. Here is the finished goods ledger. You can see what was manufactured, what was shipped. Here's the beginning balance. Here's what was shipped. Here's what was manufactured. And then here's the ending balance. Now let's sell something. So we're going to sell something on account. So Legend Guitars sold 40 jazz guitars for $850 each. So we're going to record a sale of $34,000 on account. Remember, when you record the sale, you record it at the selling price. So debit accounts receivable and credit sales for the selling price. That is different from the cost. So accounts receivable is going to go up with the debit. People owe us the money. Sales revenue is a revenue, so it goes up with the credit. Now, as far as the goods, the inventory, we have to update that. So we're going to move it out of finished goods inventory because we sold it, so we don't have it anymore. So we're going to credit inventory. We're going to credit finished goods inventory to make it go down. And we're going to move it into cost of goods sold. So what kind of account is cost of goods sold? You may remember it from accounting 1. Cost of goods sold is the cost of goods that you sold. So it's an expense. So we increase an expense with a debit. So this is how the cost flows. Okay. Materials flow into WIP. Overhead flows into WIP. Alright. And then your labor, your wages flow into WIP, your labor cost. And then we move it into WIP. And then WIP moves into finished goods. And then finished goods moves into cost of goods sold. Then it finally shows up on the income statement and reduces our net income because it's an expense. Now, period costs, everything we just discussed were product costs. Period costs are going to be your selling expenses, anything that didn't involve making the product. Selling admin expenses related to managing the company, selling the goods, nothing related to the manufacturing. So when you record period costs, they go straight to the expense account. They don't go into the product. So you would credit your expenses and then, debit your expenses and credit your payables.